Wednesday, March 6, 2019, Maneco 64, home of alternative economics and contrarian views. This morning I want to look at technical analysis and the kind of strategies I use to advise my clients to do or did myself in options. Some of you might be interested, some of you might not, but it might be of value for you to look at, maybe to learn a little bit about risk management and why I think options are interesting. Of course, there are plus sides to options and downside to options as well in terms of utilizing it. And I want to talk about just the technicals, because sometimes we get caught up, all the fundamentals, all the politics. The picture for me right now doesn't look great at all for the stock market, the S&P, the NASDAQ, or the Dow. And I want to show you some charts I looked at. And then I want to go through some strategies that I put up for S&P options in order to maybe capitalize from a possible move. Because in markets and in life, nothing is really for certain, but we can try to judge the probabilities of things happening. And of course, I don't get everything right. A few weeks ago, I said gold was doing really well. It had been going up for 5 months running, which was the first time in many years. And lo and behold, gold turned around and actually went down in February. And now we're even lower. So no one's perfect, but we can try to navigate things. And that's what I'm going to look at today. Before I go into that, of course, I'll look at what the markets are doing this morning. Yesterday was a fairly quiet day in terms of market move. The stock markets were down, but nominally, not a huge amount. So it's just gone past 8 o'clock a.m. London. Right now, we've got spot gold at 1288.50. The high overnight has been 1291. It was actually around 1290 about half an hour ago when I was getting ready to do the video. The low's been 1285.88. I saw yesterday gold did dump quite sharply, like from 1286 to 1281 or so in a matter of a minute. And what was that? I think I tweeted and said, where's the CFTC? Well, it was at 10 p.m. It was at 10 a.m. New York time. I think there was a economic statistic that was released then. It could have been algorithms hitting the futures market. It could have been anything. But one thing I would say about gold and the technicals is I spoke months ago that the 1283, 82 area was a very important retracement on a longer term basis. So it held that level for now. Silver kind of outperformed yesterday. This morning it's unchanged at 1512. The range has been 1506 to 1517. The Dow futures right now, it's at 25,784. It's down about 25 points, so still very subdued markets. S&P is down 2 3/4 points, 2786. The NASDAQ 100 future is unchanged, 7155. Currencies were the pound is down 1/3% at 131.37. I saw a headline on Zero Hedge saying that the EU and the ECB are going to activate emergency currency swap line to brace for a no-deal Brexit. What that means is that the ECB might provide euros for UK companies, they say. Well, that means UK banks, right? Because it's the major UK banks, London banks, who are huge in all kinds of currency markets. Anyway, Euro 113.01, so testing the figure here, down only about 6 pips though. Dollar down 10 pips at 111.78 against the yen. And the dollar is a little strong against the yuan. up 0.2% at 671.75. Crude oil, while WTI is down 0.75%, 56.31, and Brent crude is down 44 or 2/3 at 65.41. The bond market has rallied in the last few days. The 10-year yield right now is at 271, so we're down about 4 basis points on the week. That means the prices have gone up. The 1-year yield is 254, 5-year is 252. So the curve is still inverted, but only by 2 basis points at the moment. The technical picture, and what I would call the mother of all head and shoulders formation for the S&P index and the NASDAQ 100 index, which I've got here, and I'll show you in a minute. What is a head and shoulder formation? Well, it's a bearish formation, usually formed at the top of the market. So you've got like a shoulder, a head, and a shoulder, and then if you break the neckline, you will go the same distance from the neck to the top of the head. That's how you measure it. Timing wise, it's difficult to know, but you can kind of estimate, I would say, by looking at how long the head, the shoulders and the head took to form. Maybe you can extrapolate, but it's really impossible to know exactly the dates, but it gives you a target on the downside. That's what it does. And as some of you might know, I worked in the financial markets and in the city of London for 20 years. I started out in Switzerland. I worked as a futures and options broker for about 15 years. My clients were institutional clients, so not private clients, so what I'm going to show you here is what maybe one of the fund managers I spoke to would have asked me, what do you think of the stock market? What are you seeing? And this is what I would tell them. Even though the core of my business was bonds, I did have some clients, some big funds, where I spoke also to the equity guys. So first of all, let's look at these charts that I was looking at last night, and I found them quite interesting. The first one is I'll look at the NASDAQ 100 future, or the NASDAQ 100. So you can see here what I mean about head and shoulder. And right now, the right shoulder has not has not evolved. It is a probability. I'm looking at it and I'm saying, wow, this looks like a massive head and shoulder for me. The neckline is a little bit kind of deformed, you'd say. So I've done a little bit of drawing here, and I've come up with some a price objective on the NASDAQ 100. And I measured, of course, from the neckline to the top. And I took that distance and measured it from the break of the neckline there to the objective, which is 42.80 in the NASDAQ 100. That would be a drop of about 45% from the all-time high, around 77.25. I might get these numbers not exact, but it gives you an idea of where we could go. And of course, this is not for sure, but it is a probability, and it gives you some kind of trading idea, to put on, to protect. Maybe you work for a big fund, maybe you have portfolio of stocks. So now I'm going to show you the S&P 500 chart. So the S&P looking very similar as well. If we're going to have a right-hand shoulder here, the right-hand shoulder is also a little lower than the left, but it still looks like a massive head and shoulder. And if you look also back in 2007, 2008, when when the crisis started, and then we had the collapse in the stock market. That was a bit of a head and shoulder top there, and it took a while for it to form. And it's the same thing here. It's been forming since the beginning of last year. The left shoulder, if we're going to have a head and shoulder here, was formed in the beginning of last year. The head was formed in the middle of last year. The right hand shoulder has been forming since Christmas, I would say, since that low we saw on December 24th. So I've taken that and then I extrapolated. Maybe if we go down here and we go test the neckline, that will be another 3 months or so. And then from the neckline down to my objective, which is 1,835, that might be another 3 months. So let's say the neckline could be reached in June, then the objective could be reached, in September, October, or sometime around that period. This objective I have is 1,835. If you take the all-time high is around 2940 or thereabouts, it would be 37.5% decline on this move. Am I saying this is going to be the bottom at the end, towards the end of this year? If this happens, maybe, or maybe we'll pause there and continue lower. I looked at the CBOE website because I haven't been trading options for a year or two. I used to have an account in the US, Options Express. But just to let you know, I'm not probably going to put this strategy on, and I'm not recommending it. I'm just telling you what I would be talking to my clients about in lieu of this potential head and shoulder, because it's better to, in my opinion, to put it on before it's very clear that it's forming than after it has already started, because then it's a little too late. Not too late, but it could still catch the leg down past the neckline. So I looked at the S&P 500 options on the CBOE.com, and I found that there's two kinds of options you can do. The SPX, but the SPX, the nominal amount for each contract is $200,000. So the premium is going to be quite high. But I looked at some strategies, and these are all June options. They expire on the third Friday of June, 21st of June. So I looked at the 2600 put, buying that, and selling the 2400 put. That's called a put spread. And why would I do that? Well, because it helps you cut your cost. So I'm paying 33 for the 2600 put, and I'm selling the 2400 put for 14.5. So I'm paying 18.5 instead of paying 33 for the 2600 put. And I do 1-to-1, so there's no risk. You're going to be short the 2400 put, but you're long the 2600. So you cut your costs there. The only thing about this is that if the market by June really crashes right through that neckline very quickly, and we have a major collapse, you will make the $200 difference there minus your premium, but you won't make any more because having the put spread will limit you to that amount. So that's the only downside there. Of course, options, the other, you know how much you're going to spend, but and you know how much you can lose. So there's no unlimited amounts. If you go short the futures and then the market goes up, there's no such risk. The reference, by the way, was 2,789, which was yesterday's close. And then I've looked at the 2,700, 2,500 put spread, and that's a little closer. It's near the money. So it's going to cost a bit more, 29.5. And then I looked at the SPY, and if I was going to do this as a small investor and not an institutional investor, I'd do the SPY because it's cheaper. So, and it's on the SPDR ETF, by the way. So it's the same strikes, but the SPY instead of 2,600 is 260, 240, and you're paying 148 there. So that's times $100. So for one put spread, you'd be paying $148. The total you could make is $2,000 per put spread. You need to also, I would say, if you were gonna look into this, to make sure that you're not paying a lot of commission with your broker, because it might not, defeat the purpose of trying to do a put spread. And then I've looked at the 270, 250 as well on that, and that's a net $3.08, so $308 it would cost you. Again, the maximum profit there at expiry would be $2,000. So minus the premium, of course. That's the kind of strategy I would be talking to my clients. And if any of you guys want to, speculate on this would be a great thing to do, in my opinion. Of course, some of you might be already trading options, and you might do other strategies. Or I used to also like buying way out of the money puts, very cheap, but then you really need a big move. But put spread is more, it puts you more in the game. The market starts moving down, you start seeing that price of your strategy going up. Some of you might say, well, technical analysis doesn't matter anymore, the markets are manipulated. But to me, it seems like we are forming a head and shoulder. I don't know what's going to happen, what could trigger this, but it's not looking great. If you enjoyed this video, make sure you hit the like button. If you're not a subscriber, but you enjoy my videos, think about subscribing. Also, don't forget to hit the little notification bell up here so that you're notified of all my videos. And you can also follow me on Twitter, Steemit, and on DTube. I wish you all a great day. Take care. Bye.